Hello. One thing that always proves very difficult with investment markets is looking around corners at what will happen in the future. Right now, investment markets are being concerned with high and rising inflation combined with slowing economic growth, but these are not long-term issues. It seems that every few weeks there's an "oh my goodness, what's happening now" moment, and most people seem to have turned into experts about how bad the economic situation will get. You'll be pleased to know that the large amount of strategists predict that there'll be a minimal global recession at worst. And recessions don't mean falling markets, as markets have already priced in bad economic data before recessions arrive, just like they have in this current time. At present, the war in Ukraine is contributing to both a food and an energy crisis, while China's zero COVID policy is leading to further disruptions in supply chains. The war and the continuing impact of COVID-19, particularly in China, both add to concerns about inflation and growth in the short term. The first quarter of this year, in fact, was the first quarter since 1989 when not one asset class made a positive return, and the second quarter isn't looking like a good one either. The current doom and gloom market mood is not warranted given the opportunities available in the wake of recent asset repricing with falling prices and shares. Now is not the time to be sitting on cash, as this has been eaten away by high inflation numbers. And this was shown just this week when Meridian offered a corporate bond at 5.5% for 5 years. So fixed interest as part of a diversified portfolio is going to play a big part very soon in the next few years coming up. The bright point in this current correction is that the days of getting minimal returns from fixed interest, which has been happening for the last few years, is over for the foreseeable future. Large global bank Citigroup, they were forecasting an asset return of 3.7% for 2022, almost double their earlier forecast, which was 2% in January. Given this slowing backdrop, we see a much more compelling opportunity in fixed income assets for both overall portfolio construction and also for the ability to earn income on surplus cash coming up over the next few years. Our base view is that the Federal Reserve in America uses an even-handed management of interest rate increases that keeps recession at bay, as inflation is basically taken away by other natural causes such as shipping costs, etc., which have started to fall already. If we were to assume that there is no recession, but rather a slow market consolidation, investors will see that the future environment will basically be normal moderate growth. So we can expect choppy seas as markets are likely to remain volatile in the short term, but this is a lot of uncertainty out there that needs to play out and evolve over time. But pay particular attention, I think, to the war in the Ukraine and how that evolves, and how China carries on with its lockdown policies and how they ease these. While the short term continues to be uncertain, we know that long-term trends are not going away. The real issues that investors need to focus on need to be things such as climate change, changing consumer behaviours, the rise in rapid digital technologies, an aging population in the developed world, the rise of China, the rise of debt levels. These are all issues that are going to be around for the next 20 years, not just for the next 12 months. The things in the next 12 months are the things that are causing the volatility. Perhaps the biggest risk at times like this is the behavioural mistakes that investors make. The way to avoid these mistakes is to have the long-term plan that you develop with your advisor. Make sure that plan is based on a core set of principles and beliefs that are going to be for a long time horizon, and then stick to the plan, as investment is a long-term game, and history has always shown us that fortune often favours the brave, as asset prices have always gone up.